To fill out the W-4 if you're married filing jointly and you want to do itemized deductions versus the standard deduction. Now, towards the end, I'll let you know what I personally recommend and why, but this is a scenario that many people have considered. So let's dive straight in. I want to go through it fast. I've already filled out some information just so this video is not too long. So we made it to the IRS website. You clicked and found the tax withholding estimator. It brings you to here, the About You section, step number 1. So this couple is married. They're filing jointly. They will have taxes taken out. So we selected yes there. Nothing else applies right here. So we'll hit next. Income and withholding. So they have 2 jobs, one each person has 1 job each for a total of 2. Both of them have an hourly job. This first one is pertaining to the initial individual who's filling it out. They plan to work at that job all year. They plan to get paid twice monthly. That represents if a person get paid on the 5th and the 20th or the 1st and the 15th. Then right here it says use your most recent pay stub. Their most recent pay stub is when their pay period ends on January 31st. Then the most recent pay date was February the 1st because they get paid on the 1st and the 15th. The last paycheck was a good representation of how much they get paid. They get paid $2,000 every pay period. And year to date, they've earned $6,000 because they've been paid 3 times. They got paid January 1st, January 15th, as well as February 1st for a total of $6,000. Then it says based on the information provided, looks like your income for this year would be $46,000. Yes, that's correct. They are taxed $200 every time they get paid. Year to date, that's $600. Basically $200 times the 3 paychecks that they receive, $600. Then the second income source, it's another hourly job. It represents the spouse. They plan to get paid all year, twice monthly, 1st and 15th again. Same dates apply. Their last pay period ended on January 31st. Last pay date was February the 1st. The spouse paycheck was a good representation. Then they get paid a little bit more. So let's say they get paid $3,000. They've been paid 3 times. So 3 times 3, $9,000. And then the representation of their annual pay is looking to be $69,000. Is this correct? Yes. They're taxed a little bit more as well. So $300 is what they're taxed per pay period. Now it says enter the federal taxes paid year to date. 3 times 3, since they've been paid 3 times, $900. Nothing else is changing. So we're keeping everything else blank. We select next. Adjustments to income. So no adjustments to income in this example. So again, we'll select next. Now, for the first part of this example, the standard deduction, we'll keep it at that. I want you to see what it looks like when you add a little bit of itemized deductions. But with the standard deduction, them being married filing jointly, their standard deduction amount is $30,000. So in order for them to itemize, that amount needs to exceed the $30,000 in order for it to even be relevant. But for now, we're just going to leave it at no. Use the standard deduction. We'll hit next, and then it asks what age they'll be next year at the beginning of the year. Let's say 40 and 41. Then we'll hit next again, and it takes us to the results page. So based on this information, it says you're withholding more tax than you need from your paycheck. Expected tax withholding, if they do nothing else, they're going to end up paying $12,000 for the year. The anticipated tax obligation is $9,000. They were only obligated, quote unquote, to pay $9,726. So that means that their projected refund will be $2,274 if nothing changes. However, it also lets them know to increase your take-home pay, you can just submit another W-4 form, and we're showing you how to do it down below. Basically, it lets you know you can download a pre-filled out W-4 here, and then it gives you the steps if you have a W-4 already printed out and you just want to go ahead and put it in the way that they suggest. So that's totally up to you, but the results are pretty much there. You can just print out a pre-filled one. It's pretty simple. Now let's go back to say they itemized. So on this section, instead we will select yes, we plan to itemize. Now with the itemized deduction, it only a certain amount of things that you get to write off. This is why I recommend, instead of itemizing, that a person should consider having a business, an online business, something that allows them to tap into hundreds of tax deductions, because it has a direct impact on them lowering their tax liability and putting more money in their pocket. However, let's put in some numbers and say that they know that they plan to itemize because they know they're going to have quite a bit of medical expenses. Let's say that $25,000 that they have in medical expenses, which may fit some people's scenario. Let's say that they also have state and local tax. So let's say that they, spent $6,000 in state and local tax. Let's say that they qualify mortgage interest and investment interest expenses was $2,000. And let's see what that equates to. Okay, for a total of $33,000, which is more than the $30,000 if they would have taken the standard deduction. So what we're going to do is hit next. Nothing else changed. All we did was just adjust to have them itemized for a little bit more, $3,000 more. Let's see what changed about the results. It said based on the information you entered, you're withholding more tax than you need to from your paycheck. They still expect to have a tax withholding if nothing changes of $12,000. That's what they'll end up paying. The anticipated tax obligation, $9,726. Projected refund still $2,274. So this is the reason why, if a person is planning to lower their tax liability, one of the best ways is to have a business, because the business would allow them to lower their tax liability, and this projected refund would have gone up. So it would have been a higher amount in the refund. And if they decided that they wanted to get some of their money throughout the year, guess what? They could have and still had a decent refund, because it would have been based on how many tax deductions they would have been able to acquire throughout the year, as long as they're doing business with the intent to make a profit, following all the guidelines, keeping records, etc. But I just wanted to show you that even with itemizing, sometimes it may not have the impact that it could if a person had a business. Be sure to check out any of our links available around this video if you want help with taking full control of your tax scenario and getting experts to do the work for you. Mr. Smith signing out. Salute.